The stock market is at all-time highs. Investors are feeling confident, portfolios are growing, and many people are starting to believe that investing is easy. That is exactly when the biggest investing mistakes are made. You see, investors rarely lose the most money when they are terrified. They usually lose the most money when they become overconfident. The scary part is that this happens in every market cycle. The stocks change, the headlines change, and the technology changes. But investor psychology stays remarkably similar. In this video, I'm going to show you the 5 emotional stages every investor goes through and explain why understanding these stages could save you from making one of the most expensive mistakes in investing. Let's start with the first stage. Stage 1, Excitement. Every investing journey begins with excitement. An investor opens an account, buys a few stocks, and starts watching the market closely. Then something wonderful happens. The investments go up. The investor feels smart. The future looks bright, and the portfolio is growing. At this stage, investing feels easy. Psychologically, the brain is being rewarded. Every gain creates a feeling of progress and success. The investor becomes more engaged. The investor checks the portfolio more frequently and begins imagining future wealth. There is nothing wrong with the excitement. The problem is that excitement often creates overconfidence. The investor starts believing that the gains are entirely the result of skill. That belief leads directly to the next stage. Stage 2, Confidence turns into greed. This is the stage that matters most right now because when markets are making new highs, many investors find themselves here. At first, the investor is simply happy with positive returns. Then something changes. A 10% gain no longer feels exciting. A 20% gain becomes the new expectation. The investor starts looking for bigger opportunities, riskier opportunities, or faster opportunities. Social media makes this even worse. Everywhere the investor looks, someone claims to have found the next big winner. Someone claims to have doubled their money, and someone claims to have discovered a stock that cannot possibly fail. The investor begins comparing results, and comparison creates greed. The investor starts chasing performance instead of following a plan. This is where many people make the mistake that inspired this video. They mistake a bull market for investing skill. They assume rising prices validate every decision. History shows that this assumption can become very expensive because eventually the market enters the next stage. Stage 3, Doubt. At some point, markets stop moving straight up. Maybe it is a correction, maybe it's a disappointing earning report, maybe it is unexpected economic news. Whatever the reason, prices begin falling. At first, investors stay calm, but then they start asking questions. What if I bought at the wrong time? What if I paid too much? What if this is the beginning of something worse? The same investor who felt confident a few weeks ago suddenly feels uncertain. The market has not only changed prices, the market has changed emotions. Stage 4, Fear. As losses increase, fear begins taking control. The investor no longer focuses on future gains. The investor focuses on avoiding future losses. Every headline feels threatening. Every red day feels personal. Every market decline feels larger than it actually is. Psychologists call this loss aversion. Human beings experience the pain of losses much more intensely than the pleasure of gains. That is why fear causes investors to do things they never planned to do. They abandon strategies, sell quality investments, and make emotional decisions. And unfortunately, many people sell near the exact moment they should remain patient. Stage 5, Wisdom. Eventually, markets recover. They always have throughout history. The investor looks back and realizes something important. The biggest mistakes were not caused by the market. The biggest mistakes were caused by emotions. Greed encouraged chasing, fear encouraged selling, overconfidence encouraged risk taking. That realization creates wisdom. Wise investors stop trying to predict every market movement. Wise investors stop chasing every trend and stop allowing emotions to make financial decisions. Instead, they focus on discipline, they focus on consistency, and on long term wealth creation. Most importantly, they understand that successful investing is not about mastering the market, it is about mastering yourself. One of the most valuable lessons I have learned is that market becomes most dangerous when it feels safest. When markets are crashing, everyone talks about risk. When markets are soaring, almost nobody talks about risk. Yet, that is often when investors become vulnerable to overconfidence. The market rewards discipline far more often than it rewards excitement. To conclude, the stock market may continue moving higher. It may reach even more all time highs. Nobody knows exactly what will happen next. But one thing is certain: investor psychology has not changed. Right now, many investors are feeling excited. Some investors are becoming greedy. A few investors may already believe that investing is easier than it really is. This is the mistake you want to avoid. The goal is not to become fearful when markets are strong. The goal is not to stop investing when optimism is high. The goal is to stay disciplined when emotions are trying to convince you that the rules no longer matter. Because the biggest investing mistakes are rarely made during moments of panic. They are usually made during moments of confidence. If you enjoyed this video, make sure to like the video, subscribe to the channel, and share it with someone who needs to hear this message. And let me know in the comments, which emotional stage do you think most investors are experiencing right now? Thank you for watching, and I will see you in the next video.